We're going to talk today about digital services, particularly on Canadian changes, which will be effective very soon. We decided that once we talk about Canada, we should include Mexico because it's our sense that all of the BPM clients are active in either of those markets and maybe both. I have with me today two other firms who work with BPM. We'll start with Stephane Marcassa from Richter, which is a Canadian firm. After Canada, we'll start Mexican rules with Rodrigo, Covarrubias, and we have Cesar, Gamez, Rodrigo, who will talk about the Mexican rules, which again is an important market for our clients. If there are any questions afterwards, please feel free to contact us. We'll start with Canada because that's in terms of timing the most urgent one. And after that, we'll go through the Mexican rules. We'll start with a summary of the VAT rules, and then we get into the digital services piece. So thank you very much, and let's start with Canada.
Thank you, Frank, for the introduction. In my part of the presentation, we'll focus on the new GST HST registration requirements for foreign vendors and digital platforms. And as Frank mentioned, they will be effective as of July 1st, 2021. So here you have a map of Canada with the different provinces and territories. And essentially, you can have 4 different types of tax that could apply. The first one is the federal sales tax, which is called the goods and services tax, the GST. It's a VAT that applies at a rate of 5% across all provinces and territories. However, some provinces have decided to harmonize their own retail sales tax with the federal. So in those provinces, instead of the GST, you have the HST, the harmonized sales tax that applies at different rates. So on the East Coast, you have 4 provinces that have the HST at 15%. And in the middle, you have Ontario, which has also an HST at 13%. Remaining on the east side, you have Quebec in the middle that has its own provincial sales tax, the QST. It's also a value-added tax, very, very similar to the GST, but it's a separate legislation, so you have separate registration and separate compliance to it. If you go back to the middle of Canada and going west, you have 3 provinces that also have their own retail sales tax. It's Manitoba, Saskatchewan, and BC. So those provincial sales tax, it's not a value-added tax, it's a retail sales tax. It's conceptually very similar to the sales and use tax that you have in the United States. So when you do business in those provinces, 2 different type of tax under 2 different regimes. So going to the next slide, quick overview of the current GST HST rules for registration. Every person who's making taxable supply in Canada is required to register, except if it is a small supplier or if it is a non-resident who does not carry on business in Canada. Carry on business is not something that is defined in the legislation, and people would rely on the list of factors to determine whether a person is considered to carry on business or not. So for a US vendor, if it's strictly selling into Canada to Canadian purchaser, most of the time this is not sufficient for them to be considered carry on business in Canada. They would need to have a little bit more factors and presence in Canada. Once you're registered, then you have to collect the tax on almost all the goods and services that you provide in Canada to anyone, consumers or businesses. It doesn't make any difference. In terms of compliance, then once you're registered, you have to charge, collect, and remit the tax to the Canada Revenue Agency, and you have to file returns. So the tax applies on the sales, but it also applies at the time of importation of goods into Canada. So GST will be payable at the border on commercial importations of goods into Canada, and the importer of record will be responsible to pay and remit the tax to the Canada Border Services Agency. So when you have a vendor that is not registered for GST and is the importer of record, it will not be entitled to recover the tax. However, the law allows a mechanism for the Canadian purchaser to recover the tax. If the vendor is registered, and again, the importer of record, then it will be entitled to claim a credit for the GST paid at the border. The federal government also has agreements with the different provinces. So for non-commercial importations of goods, you will have the provincial sales tax that will also be payable to CBSA. So the tax at the border applies only to goods. So if you are providing services in intangible and you're not registered, so you don't need to collect the tax, and the tax is not payable to CBSA. However, Canadian purchaser, they have an obligation to self-assess and remit the tax. When you're talking about individual consumers, most of the time they're either not aware of that self-assessment requirement or they don't comply with it. So that's an issue for Canada. So because of that, and following the recommendations of the OECD, Canada finally came up with new rules to force flooring vendors and digital platforms to register for GST HST. Those new rules essentially covers 3 different types of transactions. You will have cross-border digital products and services that are being provided to Canadian consumers. And when we refer to consumers, it means any purchasers in Canada who is not registered for GST HST. Second type of transaction would be for sales of goods that are delivered or made available to purchasers in Canada. And that would include goods that are physically located in fulfillment warehouse in Canada. So those would be considered as qualifying sales of goods, and they would be subject to the new rules. One of the exceptions is if the goods are being shipped by mail or courier from outside of Canada, then they would be not subject to the new rules. The third type of transaction is for short-term rental accommodations that are being provided through online platforms. So the Canadian government wants all of the rentals to be taxed. So either the owner is registered and will collect the tax on the accommodation, or if they are not registered, then the operator of the online platform will be required to register and collect the tax. Important aspect that you have to consider for the new rules. First of all, for digital products and services and short-term accommodations, you have a registration threshold. So if you must exceed 30,000 of sales to consumers over a period of 12 months. If you do exceed that threshold, then you will have a choice to register for the simplified regime of GST HST, which will provide everything will be performed online. It's supposed to be very easy to comply, remit the tax, and file returns. And once you register under the simplified regime, the tax will only apply on the B2C transactions. For sales of qualifying goods, again, you have the same registration threshold, 30,000 for a 12-month period. If you do exceed that threshold, then you will have to register, but under the normal regime. So the difference between the simplified and the normal regime is that once you register under the normal regime, you will have to charge the tax on all of your transactions, not only B2C, but B2B as well. However, you will be eligible to take a credit for the GST that you have paid at the border on the importation of the goods. Who has to register under the new rules? It really depends on who is doing business with who. So for cross-border digital products and services, if the foreign vendor is selling directly to the Canadian purchaser, that vendor will have an obligation to register and to collect the tax. However, if the product and services are being provided through a distribution platform, then it will be up to the operator of that platform to register and collect the tax. On the next slide, you will have the same concept for sales of goods in Canada. Again, if a US company is selling directly to purchaser in Canada, qualifying sales of goods, then they will have to register and collect the tax. However, if qualifying sales of goods are being performed through a distribution platform, then it will be up to the operator to register and collect the tax. So when you do business in Canada, you will have now to consider those new registration rules. But remember, as I mentioned before, certain provinces have their own retail, their own sales tax system. And all of them, they have already implemented extended registration requirements for foreign vendors. So you will have to take those into consideration as well. Last point, the Canada Revenue Agency has announced that they will take a practical approach to compliance and that they will exercise discretion in the administration of those new rules. So if you are a US business doing business in Canada, subject to the new rules, then you may want to consider whether you can benefit from those administrative relief for that for the next 12-month period.
Okay, Stephane, thank you very much for this section of the presentation. Obviously, this will be potentially having an impact on our clients, because I would think that most of them have some kind of a transactional basis with Canada. Again, in terms of the timing, since we are in late June with a system applicable as July the 1st, what's your advice for the affected BPM clients, or in general, in terms of timing to get this whole straightened out? Is the simplified procedure going to be done in time, or what's the thinking in Canada?
Well, for your clients, I think they would have to get to know those new rules and see how they're transacting and doing business in Canada, to see if they could be subject to those new rules and whether or not they have to register. If they have to register, the Canada Revenue Agency will make available an online platform dedicated to foreign vendors. That platform will be available on June 25th. So at that time, you will have about less than a week to register and comply with the new rules. So it's a very short period of time.
Well, again, thank you very much. That was very helpful, somewhat alarming, maybe, to a certain extent. Let's go to our neighbors on the south. So we will have a somewhat similar presentation. We'll start with an introduction of the Mexican VAT rules, and then we go to in somewhat more specifics regarding digital services.
Thank you very much, Frank. Yeah, I think we'll see a lot of similarities, and like Stephane did, I would like to, in the next slide, take a minute or so to sort of go through what the general VAT system in Mexico is. I think that it's very important to have a little bit of context on this. We have a general 16% rate. VAT is a territorial tax, and it's based on the common VAT system, which allows the offset of the input and the output VATs, and ultimately, the result is that it lies on the end consumer on a service or production value chain. So any sale of or lease of goods, rendering of service is subject to VAT in Mexico. In the case of import and export transactions, we have that the one that is subject to the VAT is the importer. In the case of tangible goods, it's done at customs upon entry of the goods into Mexico. In the case of services and or intangible assets, it's sort of a self-assessment that you're allowed to claim a credit in the same return to the extent that you comply with the requirements in order to claim that VAT credit, which means that you have to have VAT taxable activities, and that has to correspond to a deductible expense. In the case of the export of goods, you have a beneficial 0% rate to promote Mexico as an export country, so that it doesn't make acquiring Mexican goods or services more expensive for them. However, the export of services is limited to a list of activities, a very specific list of activities that are deemed to be exportable, so to say. So we have to be very careful on what type of activities are conducted and confirm whether or not the services qualify for the 0% rate as an export service. In the case of digital services, sort of taking it to the main topic that we're discussing here in this presentation, like a lot like the case of Canada, we have a situation that, as I was saying, the importer of those services, the digital services or the intangibles, are the ones that have to do the self-assessment. In the case of B2B transactions, it's relatively clear because properly reporting the VAT is also linked to as a requirement to be able to claim the deduction for income tax purposes. But in the case of B2C, because of the lack of business activity, common knowledge of the tax system, and maybe even a little bit of the situation with all these end consumers that are very hard to fall within the tax net of the government, there was a huge lack of compliance. Technically speaking, if we were talking about a streaming service, for example, that end user, me, for example, would have to file a return reporting that VAT and not allowing to claim that credit, so effectively paying the VAT to the Mexican government. So as we can see in the following slide, as a result of this situation, new legislation came in, was enacted effective June 1st, 2020, and it involves both income tax and VAT. So basically what they're doing with the definition of a new digital service is including a new assumption for foreign platforms to be subject to Mexican income tax and pulling it into the territorial system of the VAT. So now foreign platforms that provide digital services, instead of having the consumer or the user of that platform be the one that's subject to VAT and have to self-assess, these foreign platforms are the ones that have to register and charge and report the VAT to the Mexican government. The definition of digital services includes, streaming, download of content, dating sites, online education, and a lot more. Streaming being obviously the most important and significant one. And it also includes a specific section that defines, that has as a definition of digital services, the intermediation between buyers and sellers in the sale of goods or rendering of services through their platform. So we're talking about essentially, marketplaces, peer-to-peer platforms and similar. In both of these cases, the taxpayer is now the platform. And in the case of the intermediation services, in addition to having to collect and shift, collect and report the VAT on the intermediation service itself, so the service that the intermediary platform charges its customer, it also has to withhold income tax and VAT that is triggered on the underlying transaction that's conducted through the platform. So when we have Mexican individuals selling goods through a marketplace or rendering services through a marketplace or peer-to-peer platform, then that platform, to the extent that it collects the consideration related to that sale of goods or services, also has to withhold at least a portion of that income tax and the VAT. So generally speaking, these platforms now have the obligation to register before the Mexican tax authorities. It's very important to note that initially this registration is only for these purposes. It doesn't automatically mean that a permanent establishment in Mexico would be deemed created. However, being within reach of the Mexican government, permanent establishment will have to be very carefully analyzed in order to avoid any contingency in that regard, because we're going to be a lot more visible, and the Mexican tax authorities could start asking questions about that. They have to appoint a legal representative and have a tax address in Mexico, and they have to do a lot of filings. In the case of the collection of the VAT, of course, with the filings with the payments and the withholdings as well. But there are also a few informative returns that have to be considered. So it's very important to consider all of these obligations when we're talking about a digital platform or any type of digital service provider that has a customer base in Mexico. Unlike in the case of Europe, there isn't a minimum threshold, so it's for any transactions and any number of users, and that's very important to keep in mind. The registrations process is not that simple, unfortunately, so it is something that has to be looked at carefully.
Thank you, Rodrigo. And in the case of payments for royalties, in particular the software, regarding the income tax treatment in Mexico, it is important to mention that the software wealth shall be considered in our country if the payer of this kind of royalties is in Mexico, is a Mexican resident, and also if the goods and rights for these payments are utilized in Mexico. So the withholding tax will be the 25% of the payment according to our Mexican income tax law. But also, as you know, depending on the respective tax treaty, this withholding tax will be reduced. In the case of royalty payments, it will be around 10 or 15%. And also, it is important to mention that according to the commentaries of the Article 12 of the OECD Model Tax Convention, in the case of the prepackaged software, we can receive or use the treatment according to the Article 7, that is benefits profits. In that case, we can avoid the withholding tax in Mexico. So if we can go to the next slide, it is important also to mention that nowadays we have a discussion with the tax authorities in Mexico about this treatment of the commentaries of the Article 12, because Mexico has an observation of that, and the tax authorities try to apply the treatment of the Article 12 instead of the Article 7. So in that case, it's important to keep in mind that in the case of the prepackaged software, we can have this discussion to the tax authorities, and maybe we can be subject of the withholding tax, as I mentioned before, 10 or 15%. So this is something that you need to keep in mind regarding this kind of payments of royalties for software.
Well, I am kind of blown away by the presentations, because when we started thinking about this, we thought about geographical areas in terms of Mexico and Canada, but it seems very much so that a lot of the thinking in the countries is happening both in Mexico and Canada. You can see clearly that there is a general trend of trying to tax those digital services one way or the other. I hope the viewers of this podcast thought this was helpful. From a BPM perspective, I think, BPM is a California firm, but what we're trying to show today and also in other presentations is that we have quite an extensive network of firms like Richter and Skatt, where our clients can be made available to because of the network we have and the excellent advice. I mean, we did, just as an example, we did a seminar a couple of months ago about Brexit. We used our affiliated firms in the UK, France, Germany, and what have you. So we can really provide comprehensive tax advice as a California firm. And with that, thank you very much, and hope to see you soon on another of our BPM podcast. Thank you.